There's so much emotionally charged hype out there designed to sell newspapers and advertising rather than inform investors and traders. Want entertainment? Buy a newspaper or magazine or turn on the news. Want investment and trading concepts explained? Look to TechniTrader. TechniTrader is the gold standard in trading and investing education taught by experienced and accredited professionals. Don't learn to trade from fad-chasing day traders, and certainly don't think you can grow your portfolio by attending a weekend seminar or watching a free video online. Success in the financial markets is attainable, but like any high-paying profession, it requires the proper education to achieve consistent success. Join those happy few who've taken their investing and trading seriously. Call 888-846-5577 or visit technitrader.com.
Hi everyone, today we're going to talk about the most important data set that you can get from the stock market. Most of you are using stock charts, which is great. And there's all kinds of information on that stock chart. There's candlesticks, there's indicators, and everything that you need to understand how to trade stocks. If you know how to read the stock chart like you would read a book. Reading stock charts should be as easy as reading any book if you understand what it is you're looking at. One of the most important data sets that is often overlooked or is not taught because the older technical analysis books didn't teach it. In the original days when technical analysis was first adopted and first started with all the different ideas and concepts that came in those days, what really started to take off is in the 70s and 80s. Computers made it possible for people to draw stock charts, price patterns and things with line charts or bar charts or point and figure via a computer. So computers enabled us to develop technical analysis. And in the early days, what they were really focused on was what did price do that hour, that day, that week, that minute, whatever. They wanted to know what price was doing because they thought price was the most important data of that era. And that is true for the 60s, 70s, and 80s, and early on in the 90s. Since then, price is very important, but it's not the only piece of data that you should be studying. If you don't study another data, you will lose a lot of money and you will make less profits because you're not understanding the market dynamics. And that is quantity. There are only 3 data sets that come from the market. Every indicator, and there's over 250 indicators that have been developed over the last 50 years, all of those indicators have to have at least 2 sets of the 3 data. They either have to be price and time or volume and time. You need time for both of those. There are a few indicators that are price, time, and quantity indicators. And those are the most reliable indicators of all because you're using all of this data that is available from the market for each stock transaction. Now, I did a study and there's about 3 billion orders running through the market every single day. That's a huge amount of orders. About 37 to 38%, sometimes as high as 40%, are on dark pool venues, which are off the exchange, over-the-counter transactions of very, very large lots, ranging from 50,000 to several million block order. These are no longer routed to the exchanges. The routing to the exchanges ended someplace between 2002 and 2005 because of high-frequency traders. What happened in 2002 is the SEC approved that we would go from fractions on the price range. So instead of 25 cents, 50 cents, 75 cents, or an eighth or a quarter, and 3/8 and 5/8, which they had been told the retail traders found confusing, but in reality, it was the market makers who had discovered that there were a whole lot of floor traders who'd gone rogue independently, and the So's bandits, as they were called in those days, were trading against the market makers, and the market makers didn't like it. So they petitioned the SEC to change from fractions to decimals in calculating the price value of a stock. So instead of $1.25 or $1.12.5, it went to penny spreads. With penny spreads and the necessity to still make money, a lot of floor traders started using faster and faster computers. And as they used faster and faster computers, the speed of execution accelerated. Instead of a minute for a half a minute, it went to the second scale, and then finally to the millisecond scale. That is how the HFTs evolved. They started out as the So's Bandits floor traders trading against the market makers, and slowly over time with the speed of computers and access directly into the exchanges, which the exchanges needed because they were losing money, because about 38% of the orders that used to go through the exchanges were now done off the exchanges on dark pool venues. They were losing money right and left. So HFTs provided that liquidity and that money that they needed. So it all went to milliseconds. So then stock trades are transacting 60,000 times a minute. You can't even imagine that. You can't even see that. If that would scroll on your screen, it would be all these little tiny dots firing off on the millisecond that your mind couldn't even understand, but a computer can calculate. Why is this all important? This is important information because a lot of times you don't realize that the stock market has changed so dramatically in the last decade that it doesn't resemble anything like it was in the 90s or the first decade of the 2000s. A lot of traders started trading in the late 90s and into the 2000s to 2010 or 2007 before the banking debacle. And they are accustomed to a very different market, and they're still trying to trade it that way. In fact, some of the most prominent stock trading services teaching options and day trading still use the outdated, antiquated methods that they taught in the 90s and 2000s for a market that's completely different. And that is a huge problem, and that's why a lot of day traders and options traders lose so much money. And I think that's awful. I think that you should be making a lot of money. One of the things that you also have to track besides price, and it's imperative, is quantity. Now, quantity comes in a variety of different kinds of indicators. As an example, the quantity is the number of shares that exchanged hands for that one transaction of stocks. Somebody bought 100 shares and somebody sold 100 shares. It ends up being 100 shares when it is called the volume indicator. They don't use both sides of the transaction in the stock market as they do in some other financial markets. So be aware of that. So when somebody buys 100 shares and somebody sells 100 shares, that's 100 shares of volume only, not 200. This makes the stock market volume far more important. Volume tells us how many trades fired off on the millisecond, on the second, on the minute scale, on the day scale, on the weekly scale. How many shares changed hands for that price change or fluctuation? That is invaluable information because if you know how large the lot size is, you can determine who bought and who sold. When a dark pool needs to buy 100 share lots, a lot of times what they have to do is they have to bundle a lot of smaller lots, 10,000, 50,000, 5,000, 2,000, a few hundreds and all that to come up with 100,000 shares for the dark pools to purchase or to sell. So they combine a lot of small lots into the large lots, but that is also trackable because that's a multi-buyer or seller transaction. And every time that occurs, the National Clearinghouse has to make sure that the buyer received the shares of stock and paid for them, and the seller received the money and transferred those stocks. So all of those transactions that may occur within a few minutes or a minute or a second, and one side is 100,000 share lots and the other is all these smaller lots combined to fill that order, that information is vitally important because the dark pool venues are off the exchanges. They don't go through the exchange. You can't see those large lots going through until after the market closes because the dark pools have the privilege and right to delay their orders being sent to the national clearinghouses. From the national clearinghouses, once the order is cleared, the money is transferred and deposited and the stocks are transferred in street name. The transaction is concluded. That data then can go to the data feed providers. The data feed providers are a paid service that your software company pays for that data. They have to buy the data to put on their stock charts. It's not free. That's why they charge you a service fee, because they have to make money from the software that they develop, and they also have to pay the exchange fees, or the data feed providers, which are often exchanges, money for that data. It isn't free. A lot of you want everything about the stock market to be free. You want free software. You want free brokerage services. You want free this and you want free that. You want free education. You want free. Well, the stock market will go, sure, we'll give you this stuff free, but you'll pay at some point. Because in the stock market, everything costs money. Data is becoming more and more and more expensive because it is very, very valuable. So when we have a transaction that has a large lot on one side from a dark pool venue and a lot of smaller lots on the other side, if you knew what side that transaction occurred on, and if there were dozens of those that occurred in the day or hundreds that occurred in the day, wouldn't that be important information when you looked at the stock chart? Yes, it would be. Why? Because dark pools don't move price. Their large lots are struck on the penny. So they very rarely move price much at all. So when you look on your stock chart, you don't see a huge long white candle or a huge long white black candle or a huge gap. And if you do, if you think that's dark pools, you're dead wrong. If you've been taught that that's dark pools, they are lying to you, or they have no idea what they're talking about. The super long white and black candles, the huge gaps, are not dark pools. Dark pools are the largest giant mutual funds and pension funds in the world. They transact all of their business off of the exchanges in dark pools, which are hidden liquidity alternative trading venues. And they can do all their transactions there, about 37 to 39% transactions of all the transactions on the stock market per day are done off the exchanges. So that means that your software doesn't include all of that information until after the market closes. It also means that you really need an indicator beyond price and beyond just volume bars, because the volume bars just tells you how many shares traded hands that day. It doesn't tell you whether it was a large lot or small lot or when that large lot or small lot occurred or anything. Volume can't tell you that. And volume, the size of the bar, is relevant to how many shares were traded. The color of the bar, whether it's red for down or green for up, is dependent upon whether the stock closed above or below the close of the previous day. But that still doesn't tell you whether the large lots were buying or selling. That just tells you that the stock closed above or below the previous day. Not a lot of information there in the volume bars. It tells you that 20 million shares exchanged hands, but within that 20 million and all the transactions that occurred, hundreds of them, thousands of them, how many were large lots, and were they on the buy side or were they on the sell side? Because when the large lots are buying, what's going to happen? Think about it. What is going to happen when large lots incrementally buy 1,000 shares, 1,000 shares, 1,000 shares over a period of time, maybe several times in a day, maybe many times during a week? What's going to happen? There's going to be a huge liquidity draw because those dark pools are investing for the long term. They're not short-term trading. HFTs are short-term traders. They return the shares immediately. They buy and sell on the millisecond, so fast that your head would spin. You can't even see the actions. And you're on the minute scale, and they're trading 60,000 times a minute to your one trade in a minute. Sure, your broker executes as fast as possible to give you the illusion that they're executing you really fast, but the reality is this. As you begin to enter your order, your broker can see how many shares you're ordering, what stock it is, and they can plan and prepare. So while you're manually entering your order, which takes you at least a minute or longer to do, they're observing what you're doing. And they're able to manipulate and move the price based on whether you use an at market order or a limit order. They make money. And that's why the fees for brokerages are so low because they make their money on the penny spreads. And they have hundreds of thousands to millions of users, and so it's a lot of money in the end of the day. Now back to you. You need to know whether the large lots are on the buy side or the sell side, because over time, where they are will dictate the direction the price will take next. Before a bottom ever completes, dark pools are quietly accumulating and firing off large lot orders over time. Before a top develops, dark pools are rotating or selling stocks to lower their inventory because they believe that the company is going to underperform. So before we have a bottom and before we have a top, there will always be a surge of large lot activity for several days to several weeks or even longer. Now, isn't that really important information? Because you would know if a stock was in a sideways pattern and the dark pools were buying, drawing liquidity out with their buying over time, that stock price is going to break up. Conversely, if the stock was moving sideways, in a consolidation or platform or whatever, and you saw that the large lots were on the downside, you would know that that stock is going to break to the downside because the large lots overwhelm the buyers. The large lots overwhelm the sellers. And at some point, there is not enough stock to fill their orders and the price moves. But after they have purchased all the stock they want to own. Because just like the gurus on the retail side, the dark pools, the giants will say, oh, guess what? We bought this stock. And so all the smaller funds will race to buy that stock too, thinking that those companies know what they're doing, and they do, but it also moves price on behalf of the dark pools. The dark pools don't have to move price. They can get in at a very steady price range, and they'll never move the price much. And then when they announce or there's a sufficient liquidity draw, either smaller funds will rush in to buy on the news, or HFTs will see the liquidity draw and gap the stock up. So why aren't you using a large lot indicator based on quantity? Probably because you didn't even realize you should have one. Probably because you've only been taught that price is important. And if the pro traders and dark pools can control their price to a penny, what good is price? Price is not moving when they're moving in. The only way to accurately detect whether dark pools and pro traders are accumulating or buying a stock or selling a stock is to use large lot indicators. Now, there are only a few of them that have ever been developed. They were developed by professional technical analysts and indicator writers, specifically for the institutions. And over time, a few of them have migrated, just a couple, to the retail side. Now, they're only in certain software companies. They're available in certain softwares. And we teach these indicators. We teach how to read them. We teach how to interpret them and how to use them for entries and exits so that you have the optimum value of a huge momentum after dark pools have either bought or sold. So you're in the stock before the HFT gaps up or down. You're in the stock before the huge momentum moves. You're not chasing it. You're in ahead of time. Does that sound like something that you really should have in your trading toolkit? I really think you should. My students are extremely successful because they use large lot indicators. They understand what they're for, how they work, what to look for, what the patterns are, and they do very well because they include that in their analysis. They're just not relying on price because price is no longer enough. The markets have changed more in the last decade than they did all the prior 120 years of the modern stock market. So why are you trading like it's 1970? Because you were trained with archaic, outdated educational systems. We teach these modern indicators, which I call leading hybrid indicators, because they include all the data set and provide you with a maximum understanding of who is controlling price. Where are the dark pools buying and where are they selling? Oh, that's so important. You cannot believe how important that is because that's where the momentum comes from, folks, because their liquidity draw or their liquidity push into the market is so huge over time that it causes the momentum. They don't cause the momentum with their buying. The buying occurs and then the momentum. That allows you to get in before the big gaps and huge runs and all that momentum that you would love to be part of. You can be part of this activity. Find out how to use these indicators and how to incorporate them into your charting software. So come and visit our website, technitrader.courses. Look at our course page. Figure out which one you think is right for you. Then give us a call and find out more. I'm Martha Stokes, and that's the radio show for this week.
There's so much emotionally charged hype out there designed to sell newspapers and advertising rather than inform investors and traders. Want entertainment? Buy a newspaper or magazine or turn on the news. Want investment and trading concepts explained? Look to TechniTrader. TechniTrader is the gold standard in trading and investing education taught by experienced and accredited professionals. Don't learn to trade from fad-chasing day traders, and certainly don't think you can grow your portfolio by attending a weekend seminar or watching a free video online. Success in the financial markets is attainable, but like any high-paying profession, it requires the proper education to achieve consistent success. Join those happy few who've taken their investing and trading seriously. Call 888-846-5577 or visit technitrader.com.